Elon Musk. Take a deep dive into Twitter's valuation. So welcome to the Valuation Masterclass case study, where you're going to learn about interesting stocks and how to value them. What's interesting about Twitter is that it makes a better toy for Elon Musk than an investment. So this is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, for everybody, this is for information purposes only. Don't go rushing out and buying or selling any stock because it's not investment advice or recommendation. So let's just look at Twitter's share price for a moment and try to understand what's been going on. There he is. Elon Musk comes on the scene, and we can see that the share price was $38 on the 31st of January. And that's when Elon Musk started buying. Share price eventually on the 4th of April went to 50 when Musk announced that he acquired 9.2% for $2.6 billion. The stock rose 27% that day. Then on the 5th, Twitter invited Musk to the board and Musk accepted. But on the 9th, after realizing being on the board would stop him from going beyond a 14.9% stake, Musk refused to join the board. This 14.9% stake was something that's called a poison pill, or a way of trying to stop someone from taking over the company. So on the 14th, the share price was at $45 and Musk offered to buy Twitter for $43 billion or $54.2 per share. And the board of Twitter saw it as a hostile takeover. They did not welcome him to come. Then on the 15th, Twitter's board announced a poison pill strategy to block Musk's takeover. And the poison pill is meant, again, to stop an outsider from taking a stake in the company, a big stake, and taking it over. On the 20th, Musk secured financing. He got $13 billion in loans, which would be debt for Twitter, right? Institutions that said they would lend $13 billion to Twitter. And then $6.25 billion bank loans and $20 billion in cash from Musk. So Musk would contribute those two. And then 7.1 in equity from 19 investors. So this gives you a picture of how he was going to finance this takeover. Now, on the 24th, news reported Twitter was in final negotiation to accept Musk's offer, and the deal was expected the next day. And sure enough, Twitter's share price rose by 5% on the 25th, and the Twitter board accepted the offer for $44 billion. And that Twitter would become a private company once the transaction is completed sometime in 2022, and it's off the stock market. It is now a private company. Now, on May 11th, news reported that the US SEC and the FTC, the Federal Trade Commission, had opened investigations into events leading to the acquisition. On May 12th, Twitter CEO Parag Agrawal dismissed Twitter general manager Kayvon Beckpour and revenue product lead Bruce Fowlett. And we can see that on the 13th of May, the share price started coming down because Musk said the deal was on hold following reports that 5% of Twitter's daily active users were spam accounts, causing Twitter shares to drop more than 10%. Musk later clarified that he remained committed to the acquisition, and Agrawal stated that he expected the deal to close. So the share price as of yesterday was down to $37. So how to do research like a professional analyst? Let's look at this in more detail. This is a lesson for all of my bootcamp students and others, for all of you guys to see that once you're looking at any particular company that you choose, first thing you want to do is go look at the annual report. And so I clicked on the annual report in the website of Twitter, and what I found was this. The first page was pretty fancy, but the second page was just this form, which is a Form 10-K that has to be submitted as a document, official document to the SEC in America. And here we can see the table of contents of that document. That is the annual report, or what we can also call the financial statements. Now, on these financial statements, what you're going to see is that the actual, hold on, let's see where, I'm going to grab my pen here. So we can see a lot of different issues, right? The first thing is they talk a lot about risks. So you really want to focus your energy on understanding the risks of this business. And then also understand the management discussion and analysis to try to understand what the management is saying. But here we can see the main item, the financial statements and the supplementary data. In fact, that goes from page 58 to 101. So that's the bulk of the annual report. And that is the financial disclosures. So let's look inside the annual report and let's go to the MD&A, because it's a valuable section to get a brief overview about what the company's doing. It also mentions the most recent developments in the company and the industry. So it's a great starting point for everybody who's doing research. And here, let's first try to understand how Twitter makes money. We can go to page 47 of the annual report, and you can see that they have advertising services and data licensing, but data licensing is very small. So they really, this company is advertising, and the advertising is growing at 40%. We can see right there. So this is what my Valuation Masterclass Bootcamp students learned today, if you were paying attention to the videos, and that is revenue consists of price times quantity. Those are the two things that matter when you look at revenue. Let's keep revenue and revenue forecasting simple. So let's do a revenue breakdown together for Twitter. Here we can see the two things that matter is the monetizable users, the users that they can charge, and the average revenue per user. And what you can see is the total advertising revenue. Now, they're not charging the users, they're charging the advertisers, but the users are the products. And this is simple, price times quantity. So as you look at the company that you're valuing, always go back to price times quantity. So here we can see that the main driver of Twitter's revenue is quantity. And we got a monetizable daily active users of 217. This is as of December 31st. Now, we do already have the first quarter results, but right now we're just looking at the annual report. Now, to increase revenue, Twitter needs to attract more users on its platform, and it needs to monetize those users. So now let's understand what the user base is like. You can see it was 105 million people in 2016, and in 2020 it jumped to 192. Pandemic, everybody's home, they're bitching at each other on Twitter, so Twitter's growing its users. And then we can see that in 2021 it ended at 217. Now later we're going to talk about what percent of those users are spam or bots. That's the debate that's going on right now between Elon Musk and the Twitter board and the Twitter management. So how good is Twitter at monetizing its users? Let's look at the price component next. So here we can see, because we know the total advertising revenue, we can just say total advertising revenue divided by the monetizable users, and we get the average revenue per user. And basically it's been flat for 6 years. That's bad news. Right there, we can see that they're not really figuring out how to get more out of their monetizable users. What does that mean? That means that they're not getting that much advertising revenue. So as a comparison, Facebook generates about $40 per user per year, about 2 times Twitter. There's a long way to go. Now, Twitter doubled its monetizable users over the past 6 years. And the result of that is that they have had very strong revenue growth. We can see revenue growth of 24.5 in 2018, then 13.7, 7.4, and then 36.6. Now, what's interesting about this kind of slow growth that they got in 2020 was because though they had an increase in the number of users that was massive, they had a decrease in what they were able to earn from those users. And therefore, their total revenue didn't grow as fast as in the prior years. And you can see that they bounced back in 2020 with that 16.7 that they were earning going to 20.8. So again, we want to start at the company's website. Let's look at investor relations section. We can look at the quarterly earnings. So here you can see the first quarter 2022 earnings. And what you can see is that sometimes you'll see things presented as a table, and other times you'll see things presented as text. All the way down at the bottom of this document, you can see that it says 39.6 million. So let's say that's about 40 million of the US users, and therefore international is 189. So we can gather that from prior releases. Either they present it as a table or we have to take it out of the text. So I took it out of the text, and now you can see right here is the 40 and the 189. And from that, I can calculate a few things. First is, what percent is 40 of the total amount of revenue? And that's 18.8. And also, what percent is it growing? And you can see that the growth in the business for Twitter, the volume of people on Twitter are outside of America, and the growth is outside of America. Now, here we can see the revenue breakdown, and we can do the exact same thing and see that the revenue that's generated by the US is $672 million. And that's about 54% of revenue. And that's up about 20.7 because they are able to get more and more revenue per user out of the US. Now, Twitter has generated about $1.2 billion in first quarter 2022. And we can get a picture from looking at that. Basically, 80% of users are international. They only contributed about 44% of revenue. That would be 44 would be the 16.4 for Japan plus the rest of the world. And we can see that here. So 55% of revenue from the US, and this region is growing the fastest. So now let's look at revenue breakdown by service. We have advertising and we have subscription. Almost all of the revenue of Twitter is coming from advertising. Very little. In fact, it's falling from subscriptions. They're not getting subscriptions right. So it's only an advertising platform. And this is where the discussion about whether bots account for 5% or, as Elon Musk says, much more, then it's going to be harder and harder to get results for the advertising. They expect a lot of results and they may not get it. And then advertisers may leave Twitter if they find out that, in fact, there are a huge number of bots. So now we can look at Schedule 14A from the SEC. And this is a proxy statement. It's available publicly, and it has to do with the offer to buy. So inside there, we can see that JP Morgan gave an opinion, and Twitter retained JP Morgan as its financial advisor in connection with the proposed merger. So how does this work? The way that it works is that Twitter, basically the board of Twitter, needs to get financial advice because they need to then recommend to the shareholders whether the shareholders should take the offer from Elon Musk or not take the offer. So then ultimately it's the shareholders that make that decision through a vote. Now at the meeting, JP Morgan rendered its oral opinion to the Twitter board, and the consideration to be paid to Twitter's common shareholders in the proposed transaction was fair. They said that Elon Musk's price was fair, and that is their judgment to tell the board that you can tell your stockholders you should sell your shares to Elon Musk. Now, JP Morgan used three methods to calculate value for Twitter. And since this is the valuation masterclass, let's dig into those valuations a little bit and you'll understand them more as you go through the boot camp. So we have public trading multiples, selected transaction multiples, and discounted cash flow. Public trading just means other companies that are trading in the stock market, and selected transactions means other transactions where companies were buying other companies. So here we can see that they need to identify the selected companies. They considered JP Morgan in this case, may be considered sufficiently similar to those of Twitter. So they're looking for similar companies to compare to. And then they're going to apply the firm value to the EBITDA, which you guys are going to learn more about in the boot camp over the next few days. But here we can see the median firm value to EBITDA is about 10.8, or let's say 11 times. Alphabet and Facebook are at 10 and 7. Snapchat is at 30. At first, it would seem like, wow, Snapchat's really highly valued, but it also is the case that they don't have a lot of profit. This was a similar table as was used by Goldman Sachs, which was also hired by the Twitter board to advise them. So they had two different leading investment banks advising them. So my question is, how comparable are these companies, right? I'm looking at Alphabet, Meta, Pinterest, and Snap, and Twitter. So here we can see Twitter in 2021. So let's just look at column, the last column, 2021. Twitter had revenue of $5 billion, Snapchat $4 billion, Pinterest had 2.6, and Facebook and Google were way, way, way bigger. So are they really comparable companies? Well, we'll come back to that. The next thing is to apply firm value to the EBITDA. Here we can see that EBITDA multiple reference range for Twitter, as estimated by JP Morgan, is 15 to 17.5 times. They multiply that times the adjusted EBITDA of 2,685 million. And the key thing is they come up with a price range of 49.7 to 57.5. So Elon Musk's offer is in the upper part of that range. But the key thing is that the forecast that JP Morgan and Goldman Sachs are working with is not JP Morgan's and Goldman Sachs forecast. It is Twitter's forecast. That's what they can say. That's what we're using. Now, when we're valuing a company like Twitter, as an example, as an analyst, we're going to make our own forecasts by referencing what the management says, but also by looking at other companies and other industries. So now let's summarize. Let's look at the value that JP Morgan estimated based upon public trading EV to EBITDA multiples, or firm value to EBITDA multiples. Here we can see the public trading was 49.7 up to 57.5. So let's just say an average of about 54 is their value. Wow, that's almost identical to the offer from Musk. And here we can see Goldman Sachs, which I don't show completely in this one. I've looked at it before, didn't have a final value that they came up with here. So now let's look at summary. For 50 to 58 was the conclusion from public traded multiples, and Goldman Sachs said it was rather expensive. So now let's just look again and see. Three of these companies have no earnings before interest and taxes: Twitter, Snap, and Pinterest. In fact, just tiny or negative. In other words, the operating business of these companies is very, very tough. They're making a tiny amount of EBIT compared to Facebook and Google, which are making massive amounts of EBIT, or what we call operating profit. That's a bad sign. The business is not that strong. So let's look at selected transaction multiples. And here we can see that both Goldman Sachs and JP Morgan, I believe, used the same table. And they looked at all these transactions and said, what was the firm value over the last 12 months, adjusted EV to EBITDA multiple? And I put a red box around the transactions that happened in 2019, 2020, and 2021. I would say that some of those transactions that happened years ago are not really a good benchmark, but you can see that it's a pretty high number. 21 is the lowest right here, I believe. 21 is the lowest, and the highest is 50.6. The higher the multiple, the higher the value that they would calculate for Twitter. So here we can see that JP Morgan selected a firm value to last 12 months adjusted EBIT multiple reference range of 28 to 36. So here we saw from 21 to 50, they chose 28 at their low end and 36 at their high end. That's a pretty high multiple. And they multiplied that times Twitter's adjusted EBITDA, which is adjusted to exclude a one-time litigation related net charge. So when you're doing valuation, you usually are going to take out non-recurring items, because those non-recurring items are things that really don't, they're not something that you want to value. They're not part of the operating business. So they come up with a range of 50 to 63. Now here, I look at Goldman Sachs for a moment, and we can see that Goldman Sachs picked the exact same range, 28 times and 36 times. They are so close. And I tell you, in the world of valuation, nothing is ever that close. This made me suspicious, but let's continue on. So let's look at the value based upon public trading firm value or enterprise value EBITDA multiples. Here we can see that the range for JP Morgan was 50 to 63.4 and an average of 56.7. So slightly higher than what Musk was offering. And here you can see, my goodness, they're pretty much identical. We can see about 57 and about 57. It feels like two students in a classroom suspiciously getting the exact same answer. Well, now we can move on to this result here, and we can see that JP Morgan and Goldman Sachs got the exact same numbers for the value using prior transaction multiples. So let's now look at the profit or loss of Twitter. In fact, in 2021, Twitter made a loss, Snapchat made a loss, and Pinterest only made a profit of $300 million after 5 years of loss prior. The first two companies are just all loss. And Facebook and Google, I mean, look at these guys. It's crazy. Facebook's gone from 10 billion in profit to almost 40 billion in profit. I'm tired of paying Mark Zuckerberg. And here we can see Google's gone from 20 up to almost 80. So almost 4 times for both of these guys. Both of these companies have increased their profits in 6 years or 5 years total by 4 times. Meanwhile, these other companies are really struggling. In fact, Twitter made money in 2018 and 2019, but it wasn't real. Why? Because in 2018, they booked an $850 million income tax benefit, which was a release of a valuation allowance from Brazil. And in 2019, they had an income tax benefit of 1.2 billion from an establishment of the deferred tax asset from intra-entity transfer of intangible assets. Now, these are complicated things that you're going to have to dig in more detail, but let's just keep it simple for right now and say that the profit of Twitter in 2018 and 2019 was actually negative, but was propped up by these items. Now, before we continue, for those people who are watching who are not in the boot camp, feel free to join the next boot camp, which starts on July 25th. Just go to valuationmasterclass.com/bootcamp to learn more. So now let's look at the discounted cash flow analysis. The step 1 is forecast the free cash flows and determine the exit multiple for the terminal growth rate. So here we can see that based upon financial projections prepared by Twitter's management. So again, JP Morgan's not forecasting here. And we can also see that Twitter, that basically by applying terminal growth rates ranging from 6 to 7%, and a discount rate from 10.25 to 11.25. Now, whenever you guys hear a discount rate in the boot camp, you're going to think pizza. Always think pizza when you hear cost of equity, which is one form of discount rate. Now, you may say, Andrew, what are you talking about pizza? You're going to learn more in the course as you go on over the next couple of days. So now we can see the assumptions for discount rate of 10.3 to 11.3, and that gives an average of 10.8 and terminal growth average of about 6.5. Let's look at what Goldman Sachs had for assumptions. They also ended up at almost the identical number, 11 and 11. Where they differed slightly was the terminal growth rate went as high as 9%, and they had a final average terminal growth rate that was a little bit higher than JP Morgan. Now, for me, I would never use a terminal growth rate beyond 5%. And we'll talk more at another time of why I use a cap of 5%. Now, let's look at the next step. Step 2 is that you've got to add cash and equity investment to the enterprise value, and then you got to subtract debt to derive the equity value. So now, once we do that, then we come up with the value per share, which comes to 36.5 all the way up to 57.6. So now what we can see is 36.5 up to 57.6, an average value of 47 versus Goldman Sachs's average value. And this is based upon the DCF value. Up here, I'm saying based upon public trading multiples, but actually that's not right. It's just a table of all the different ones: public trading, transaction, and DCF, which we cover completely in the boot camp. So now we can see JP Morgan from 37 to 58 and Goldman Sachs from 39 to 61. And before I continue on, I'm going to ask Alex or Chris to monitor any questions and just shout them out once we get towards the end of the presentation. Questions that come in on either LinkedIn or YouTube, or questions that come in on the chat here in Zoom. So let's just look at each company. I decided to calculate each company's free cash flow to the firm. And we can see here that free cash flow to the firm is such a major, important variable that we need to understand. And what we can see here is that it's negative free cash flow for Twitter and also Snap and Pins. And it's massively positive for Facebook and Google. So are these really comparable companies? Now let's look at Twitter's latest earnings announcement. Here we can see what they announced. And here you can also see spam, 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 spam. In fact, when we talk about false or spam accounts, the discussion hasn't changed for Twitter. They've said the same thing over and over again, and that is there are a number of false or spam accounts in existence on our platform. We're not denying it. We have performed an internal review of a sample of accounts and estimate the average of false or spam accounts during the first quarter represented fewer than 5%, less than 5%. Now, they have been announcing 5% or less than 5% for a long time. And that tells you that it didn't go up or down, or it doesn't have an upward trend or a downward trend. They're claiming that it's always 5%. That's already a bit unrealistic. Now, so you may say, well, Andrew, if Elon Musk figures out that there's 20% spam accounts, then this deal's in trouble. But here's what Twitter says. In making this determination, we applied significant judgment. So our estimation of false or spam accounts may not accurately represent the actual number of such accounts, and the actual number of false or spam accounts could be higher than we have estimated. So this is their get out of jail free card. Say, well, we did our best. It could be wrong. It could be seriously wrong. And they're going to claim that no one can truly know, and therefore their estimate could be wrong. But what did Elon Musk say? He said 20% fake or spam accounts, while 4 times what Twitter claims could be much higher. My offer was based upon Twitter's SEC filings being accurate. Yesterday, Twitter CEO publicly refused to show proof of his less than 5%. The deal cannot move forward until he does. Now, Twitter has claimed that Elon Musk has broken his non-disclosure agreement, but what Elon Musk is saying here is that, hey, it's public information. I'm not disclosing anything in the NDA. Now, you could say that what he is disclosing is that the deal cannot move forward. And maybe that is a private discussion between the two parties. And maybe the SEC may try to blame him, or Twitter may try to blame him. So who is right, Twitter or Elon Musk? Well, let's take a deeper dive into the Twitter's fundamentals to just get a picture of what's happening there. First is gross profit. And you can see that gross profit for Twitter is 64.6% in 2021. That's a very healthy gross profit margin. Facebook is the gross profit margin champion, and Twitter is third. That means that the developing costs are low for these software companies. It doesn't take much to produce the product. Next, let's look at that EBIT margin, and we can see that Facebook is EBIT margin champion and Google is second place. The average EBIT margin of the average company in the world over a long period of time is about 10%. So these guys are absolutely knocking it out of the park. Google's been improving it, and Facebook has fallen a bit, but still it's at about 40. Operating business, though, is very weak at Twitter, and it's a disaster at Snapchat and Pinterest. So the margin doesn't look good. And finally, the net margin. Snap has never made a profit, and Twitter only in 2018 and 2019. And I showed you that was because of valuation and tax adjustments. So it doesn't look good. And in fact, when you talk about comparables, these companies are pretty comparable, but I wouldn't say that they necessarily compare well with Facebook and Google. And this is a problem that we're going to discuss in the boot camp about how you handle the situation with comparables. So Facebook and Google are killing it. They're making a fortune. And finally, if we look at the return on invested capital in this case, one of the most important measures out there, Snap is bleeding. And you're going to learn how to calculate this and how to interpret it later in the Valuation Masterclass Bootcamp. But Twitter's return to investors has been tiny. And Facebook and Google are massive value generator. Think about it this way. Facebook and Google can raise money at maybe 10%. You could say maybe even 8%, and they can make 59% on that money. The difference between, let's say they raise money at 9%, between equity and debt at 9%, and they're earning 59. That difference of 50 is value creation. These guys should be trading at very high multiples, but they're not. They're not trading at nearly as high multiples as what Goldman Sachs and JP Morgan are valuing Twitter at. And finally, inside the financial report of the company, we can find an expense breakdown and see that sales and marketing costs accounted for $300 million for Twitter just in the first quarter of the year, 300 million. And that's 23% of the total revenue of the company, and it's up about 27.5%. So sales and marketing are a key, and then general and administrative expenses are high also. So gross profit margin is strong, but Twitter's operating costs are massive, and they eat up any opportunity for profit. So my question is, would you buy Twitter at $52? So the final thing I want to say is let's help Elon Musk here take a deep dive into Twitter's valuation. And we have done that, and we've seen a lot. Now I'm going to unshare my screen and take any questions that we have. Alex, can you speak out any questions? Or Chris?
May I ask a question if that's okay?
Yes. Yep.
Yeah, okay. You mentioned earlier that the terminal growth rate, you wouldn't go beyond 5%. And that's my way of thinking too, because in journal, you see the global GDP rate is around 5%. And if we see any company that's not a startup growing at more than a 5%, that could potentially mean that they would take over the world. So why is that so many analysts still consider a growth rate that is more than a 5% or for companies that have matured?
Because they didn't take the valuation masterclass boot camp. Like they haven't thought about it. Now, there's another factor, and that is you're going to learn about how we value companies. We use a fade period. Most analysts don't use a fade period very well. And so it ends up that, hey, this company is growing at 50% over the next 5 years. How can I say it's going to grow at 3% or 5% for the terminal value? And the answer to that is that if you don't fade, you're going to bring, let's say, a 50% growth company down to 5% growth in 1 year. It's unrealistic. And that's the reason why it's important to have a good fade system and a good method for fading that down slowly over time. And so that is one of the things. Now, also, I would highlight that I've looked at the OECD data on the growth of the global GDP, and it has been about 6% or so over the last 50 years. And I would say that, as you say, you can't have, because we're looking at terminal growth, we're talking about growth to infinity. You can't have something that is a component of the overall economy growing at a rate that's faster, or else it would eventually grow larger than the economy, and that couldn't work. So yeah, I think that many times people overestimate by having too high of a terminal growth rate. And to see Goldman Sachs make that mistake, I think is fascinating. I don't know if you call it a mistake, but let's just say their interpretation. Excellent question.
Yeah, and also like them considering Facebook and Google, I would say they're obvious outliers, but they've still considered it. So yeah, that's interesting to find out too. I'd like to find out.
Yeah, so this is I think it's a fascinating case study because it gives us a look in. I know some of you guys want to become investment bankers or leading investment bankers, and you can see sometimes I look at those two valuations by JP Morgan and Goldman Sachs, and I think they were rushed very quickly because the deal came super fast and they had to put something together, and they didn't really look at it as completely as they would in a normal situation. All right, other questions?
Hi, Dr. Scott.
Yeah,
Go ahead, Tony. Go ahead.
Yeah, I just got a question. Like, so why would the spam accounts change the expected revenue when those revenue was in the past will earn with the existence of those spam accounts?
Yeah, so basically, if the spam is actually much worse, what that means is that advertisers have been paying for 95% real accounts, and instead they're actually paying for maybe 80% real accounts. And so from that perspective, you have advertisers that could complain that they've been misled. Now that doesn't change the result that the advertiser gets, right? Because if it's 20 or if it's 5, it's not changing over time by much. So they're getting a same result. It's just that now they would know a little bit more truth. Now, the other reason why it's significant is that when Elon Musk or anybody were to take over Twitter, the whole way to monetize it is to get more out of existing users. If 95% of users are real and you say, oh, instead of getting 20 from these guys, we're going to get 30 from these guys. No. We should be multiplying 20 times 80% of the users and 30 times 80% of the users. And that may make things a little bit more difficult or different and may hurt the value of the company. So it's probably a little bit more about what the impact is kind of going forward and what, advertisers may say and do.
So Andrew, so I know that in the past years, like we also have this price and quantity to get up to calculate that revenue in total. So where do we get those numbers from? Do we estimate them, or do we get a number from the financial reports?
So your first objective is to get the number from the financial reports. Some companies have good disclosures, others don't have a lot of disclosure. And if the company doesn't have a lot of disclosure, then you may try to estimate. And you may try to, put together some estimate. But sometimes I've had to value companies that don't give much disclosure at all. And all I got is how much revenue they're generating, maybe in relation to the assets that they have in place or something like that. So it just depends on what amount of information the company gives us.
Thanks.
Yep. Other questions?
Hi, Dr. Stoss. This is Omkar here from New Zealand.
Yes.
So I have a question from one of your slides, which you showed. That you showed that USA generates around 54% revenue for the Twitter, with most of the users being in USA, and Japan generates around 16 or 19. I don't remember perfectly, but it has fewer users. So isn't that Twitter's target market is Japan? Isn't it like that?
So the first thing is we can see, I'm not exactly sure why they break out Japan separately. Maybe it's something to do with the history of Twitter and Japan, or maybe Japan is their largest market outside of the US. But basically what you can see is that they're able to monetize the US users, but they're not able to monetize users outside of the US nearly as well. Now, I'll just go and see if I can find the exact reference there to see if I can give a better answer to that. But from my perspective, the key thing is that they got a lot of users around the world. I mean, everybody wants to use it because it's free. But the question is, can they actually get something out of it? Now, let me share my screen. And I think I'll share the screen of what you're asking me about. Is this the slide that you're asking about?
Yeah, that's the one.
So what we can see here is that, yeah, I suspect that Japan is probably the second largest country in the world using Twitter. But what happens is that when we want to look at the actual revenue, the international versus US, they don't break it down by Japan. So Japan is going to be in that international. But I'm not sure if I answered your question. If it didn't answer your question, feel free to ask more now.
No, because when I actually saw this slide, I thought Japan has fewer users than USA and still able to generate 16%. So I was thinking that Japan has fewer users, but still is able to generate that much revenue. Then that might be, kind of a target market thing for Twitter, where users, they can be actually monetizing their users.
Well, the problem is that if you go back one line, we don't know the number of users they have in Japan unless they've disclosed it in another part of the report. So are the users in Japan obviously the users in Japan are in this international section, but are they a large part of it or a small part of it? That's something that we just don't know.
Okay.
All right. Next question. Feel free to speak out your question if you've written something down.
Okay, I just add on LinkedIn. As you mentioned that Elon Musk offer $54.2 per share, but from the price you presented, starting from 21st of January to 19th of May, it never reached close to 54.2. I find interesting that, because if I have the access to US stock market at the moment, maybe I just buy it because the deal was struck, right? The offer.
Yep. So you would buy it. You would buy it. Let's say if the price is $40, you would buy it because you think, hey, if this deal goes through, I'm going to get $54 from Elon Musk. Now, if it went all the way, sorry, $52, 54.2. But if it went up to, let's say 50, would you buy it? Well, it's getting to be a little bit more of a question of whether it's worth it, the transaction costs, and there's a risk that the deal doesn't go through, right? So what are the scenarios here? Scenario number one, Elon Musk buys the company for 54.2. Scenario number two, Elon Musk gets the price down and says that the bot's numbers aren't real, you misled me, and therefore I'm only going to pay 40 for this company. And risk number three, or outcome number three, is the deal doesn't go through and Twitter is left in a probably a difficult position trying to find another buyer or trying to survive this interaction with Elon Musk. And you could argue that the share price could go down to 28, possible. And so the market right now is telling us that either it believes the deal's not going to go through or that Elon Musk is going to get a lower price for the deal. And they're not willing to bid it up to get closer to Elon Musk's price. All right.
Thank you.
Yep. Next question.
Hi, Dr. Stotts. Can I ask another one?
Yes.
So you talked about the market multiples like FV and EBITDA. Did they try another? Did they have any other approach of multiples as well, JP Morgan and Goldman Sachs, or just one?
No, the reason why they didn't have other multiples like PE is because the companies are losing money. So the earnings are negative, or for the comparables, the companies, it's just not that easy to compare. But when you look at the firm value, it's and the EBITDA, it's generally not going to lose money.
Yeah. Thank you.
Yep. All right. Last question. Anybody have a last question?